You hear it all the time, right? A raging bear market. Bulls are on parade. It's not just finance jargon. It's practically the language of the news. But what do these terms really mean? And more importantly, where in the world did we get these animal metaphors from? Let's dive in.
So on the surface, it's all pretty simple. A bull market, that's when things are looking up. Prices are rising, people are optimistic, and the economy feels strong. It's all about that upward momentum. And a bear market is, you guessed it, the exact opposite. A long, painful slide downwards, driven by pessimism and a struggling economy.
And I'm sure you've heard the classic way to remember this, right? A bull attacks by thrusting its horns up, just like a rising market. And a bear, well, a bear swipes its powerful paws down, symbolizing a market in freefall. It's a neat little image, super easy to remember.
But here's the thing. Is that really the story? That simple explanation? Well, it's not the whole truth. The actual origin is way more interesting, and it tells you a lot about the very nature of speculation. So let's get to the bottom of where these terms really came from.
Okay, so to find the real answer, we need to hop in a time machine and go all the way back to 18th century London, right into the heart of its wild and crazy financial district. And believe it or not, this whole story starts with a bearskin.
It all kicks off with this old English proverb. It is not wise to sell the bearskin before one has caught the bear. I mean, it's basically the 17th century version of don't count your chickens before they hatch. A simple warning, don't sell something you don't actually have yet. And this piece of advice would, funnily enough, become the blueprint for a new kind of financial.
And here's exactly how that happened. You had these traders who became known as bearskin jobbers. They took that proverb and did the exact opposite. They would sell a stock they hadn't actually bought yet, making a huge bet that the price would crash. They were literally selling the bearskin before catching the bear, hoping to buy the stock cheap later on to make good on the sale and pocket the difference. These were the original bears, speculators praying for a collapse.
And the term just stuck. By 1709, it was already popping up in magazines. But the real turning point was the infamous South Sea Bubble of 1720. Speculators bet big against the company's insane valuation, and when it all came crashing down, the term bear was cemented into the financial vocabulary for good. And from there, bull just naturally emerged as its logical opposite, the optimist, the one betting on prices to go up. By 1883, these terms were so mainstream they even had their own board game.
All right, so that's the cool origin story. But let's fast forward back to today, because now these terms are a lot more than just historical slang. In modern finance, they have very, very specific definitions based on hard data.
So, the magic number to remember is this one. A market officially enters bear territory when a major index, like the S&P 500, drops by at least 20% from its most recent peak. That's the line in the sand. Anything less is something else entirely.
And this distinction is absolutely crucial. A drop that's between 10 and 20%, that's called a correction. Now, corrections are actually pretty common. They happen all the time, they're usually short-lived, and they can even be a healthy reset for the market. A true bear market, on the other hand, is a much more serious beast, often tied to a full-blown economic recession.
Now check this out, because the contrast here is just staggering. Look at the average duration. Bull markets run for years. We're talking 3, 4, even 8 years on average. Bear markets, they are nasty, but they're usually over in about a year, maybe 14 months. And the price changes tell the same story. Bulls deliver huge gains over a long period, while bears inflict sharp, painful losses in a very short amount of time.
And if that table didn't make it clear enough, this chart really drives the point home. Look at that. The average lifespan of a bull market absolutely dwarfs the bear market. It's such a powerful visual reminder that even though the downturns feel awful, the market's long-term direction has been overwhelmingly upward. The bulls just have way more staying power.
Okay, let's zoom out a bit. To really understand the market, you have to see beyond just the day-to-day bulls and bears. The pros, they see the market in terms of tides and waves. I love this analogy. Think of it like this. The secular trend is the tide. It's a massive, long-term era that can last for 10, 20, even 25 years, setting the entire market's general direction, either mostly up or mostly sideways. And then, riding on top of that huge tide, you have the cyclical trends. These are the waves, the individual bull and bear markets we've been talking about, rising and falling on the surface of that much larger current.
So what in the world has the power to move a giant tide like that? Well, it's not the daily news cycle, I can tell you that. It's huge, powerful forces. First, you have demographics. Think of a massive generation, like the baby boomers or millennials, entering their peak earning and investing years. Second, structural shifts. We're talking about game-changing technology like the internet, or what we're seeing now with AI. And third, policy regimes. Major shifts in things like interest rate policy or long periods of geopolitical calm.
And it's so important to remember that these giant market cycles, they're not just about numbers on a spreadsheet. They are deeply, deeply connected to human psychology and the predictable patterns of our lives.
You know, more than 100 years ago, Charles Dow figured this out. He saw that these trends unfold in 3 psychological phases. It starts with accumulation. This is when the smartest investors are buying things up, usually when the news is terrible and no one else wants in. Then comes public participation. This is the longest phase, when the general public finally catches on and joins the party as things improve. And finally, you get excess or distribution. This is when euphoria takes over, there's wild speculation, and that, my friends, is when the smart money from phase 1 starts quietly selling.
So let's bring this back to that huge driver we mentioned, demographics. Because this is happening right now. The millennial generation is moving squarely into its peak earning and spending years, that sweet spot between ages 35 and 54. And historically, whenever a huge population cohort hits this phase of life, it acts like a massive tailwind for the economy and the stock market. It's a big reason why some analysts think we're in a long-term secular bull market that could last all the way into the mid-2030s.
And that leads us to one last, really big question to think about. If these powerful, generational forces like demographics are creating a slow, rising tide that lifts the whole market over decades, does that mean that the scary, dramatic bear markets we see on the news are really just temporary waves? Just short-term noise on the surface of a much larger and much more powerful ocean? It's a pretty compelling way to frame all the volatility, that's for sure.